This is Chelsea Bohm. I'm the managing director out of our Coldwell Banker Distinctive Properties Overland Park, Kansas office. Joining you from Kansas City, it's Red Friday, and I am so excited to introduce to you today our guest speaker, Leslie Lowry. She partners with us here in our Overland Park marketplace. She too is wearing red. Pay close attention to that. We love our Chiefs. Leslie Lowry is with Fairway Mortgage, and today she is going to share with us some knowledge nuggets with all of her experience in the mortgage industry. I believe it spans about 20 plus years. Is that right, Leslie?
It is. Yes, thank you, Chelsea.
Yes, well,
I'm Leslie, and yes, almost 27 years. I got into the business in 1996 when interest rates were 8.5 and survived. And survived the global financial crisis of 2008 as well. And we all will survive this one. But it's been really an unprecedented week again, this week with rates. And it's been an unprecedented couple of years for our industry following the COVID-19 pandemic. Yes, the end of mortgage forbearance is coming to an end next week, September 30th. As part of the CARES Act, or the Coronavirus Aid, Relief, and Economic Security Act. But it wasn't the only government economic bailout from COVID-19. There was also the American Rescue Plan, or the Consolidated Appropriation Act. As a nation, we were shuttered in our homes, and then we were masked, and it seemed so unreal. Commerce seemed to come to a standstill. And our federal government acted swiftly, injecting not just millions, but trillions of dollars into economic recovery. The American Rescue Plan spent $910 billion, and the CARES Act spent $2.2 trillion. We don't usually work with millions and trillions. It's hard to imagine. Just so you know, a million is 100,000 1,000 times. A billion is a million 1,000 times, and a trillion is a billion 1,000 times. So you can see they're massively different. For perspective, a million seconds takes 12 days. A billion seconds is 31 years. And a trillion seconds is 31,688 years. So when you start thinking about it, it's mind-boggling. And here's a little fun fact. If you put $1 million in the bank and withdrew $1,000 a day, you'd be out of money in 2.7 years. But if you put $1 billion in the bank and withdrew $1,000 a day, you wouldn't run out of money for 3,000 years. And we won't even talk about trillion because we don't have trillionaires yet. But the amount of money that our federal government has spent for the recovery is astounding. Part of the CARES Act was mortgage forbearance. It was not loan forgiveness. Most of the debt was put on the back of the loan. There were mortgage modifications. Borrowers only had to notify their mortgage company that they were impacted by COVID-19, and the lender suspended mortgage payments for 6 months and gave people an additional 6 months extension. They didn't have to prove they were impacted. All they had to do is say they were. I can't tell you the number of people that I've spoke to in the last couple of years who called to refinance but were in mortgage forbearance and who had not lost their job and did not have the disease. People did the mortgage forbearance simply because they could. Of course, they found out pretty quickly that you can't refinance until you're out of the mortgage forbearance plan and make 3 timely payments. During the mortgage forbearance time, lenders couldn't report negatively to the credit bureaus, and if borrowers did not resume payments, then they had the foreclosure moratorium. That's also over. So after 2 years of massive government intervention and mortgage industry efforts to prevent defaults They're now reporting that mortgage foreclosure filings are returning to 2019 levels. And when I first thought about this, I thought, how can this be? I mean, how come people can't pay their 2% and 3% notes? Of course, there's always reasons for foreclosure. There's sickness, there's loss of job, there's divorce. But then it hit me. It's taxes. Mortgage payments have gone up hundreds of dollars due to taxes. It's really no surprise because home values have increased 42% since 2019, and real estate taxes have followed. The good news for you guys is that 90% who start foreclosure filings have positive equity in their homes and would benefit from selling rather than losing everything to foreclosure. So I say to everyone, stay in touch with your peeps and see how they're doing, because there's some business out there. Thank you.
That's awesome. Thank you.
Meeting everybody.
Yeah, Leslie, thank you so much. I just wanted to put a quick shout out in the chat if there are any questions. I don't see any that have come through yet, but I think it's really important, like she said, to keep your people close. I love the fact that you promoted our real estate agents talking to those that can benefit from selling instead of, prior to being foreclosed on. So that's important. Can you speak to, I know that we just heard here through NPR, like the rates increased again. What does that look like?
Well, I haven't pulled rates in the last couple of days, yesterday or today, because I've been in different meetings and stuff, but I expect to pull rates today and probably see 6.5. During these times, people who have been on the planet for 30 or 40 years have seen higher rates. But when you're talking about first-time home buyers, they're more sensitive. You say 6% to them and they freak. And that's why right now, especially with first-time home buyers, I don't focus on rate. I talk payment and cash to close and see if they can tolerate the payments. Of course, we have 2-1 buy downs. We're going to see a lot more ARMs in this market because of it. I do like the 2-1 buy down because it's a fixed rate and it discounts the rate for the first 2 years. But the good news is that our business is changing, but we will adapt. A lot of people who weren't professional realtors, I think, will get out of the business, thankfully. And so I think it'll even out, and hopefully home prices don't decline too much.
And just for the benefit of everybody out there, can you talk about what that, what did you call it, 2-1 buy down? Like, can you just kind of touch on what that is?
Yeah, a 2-1 buy down is where you temporarily discount the mortgage for the first 2 years. It's where you negotiate that from a seller. And thankfully now we have entered a market where that's possible. Of course, 40%, I think, of homes are still selling at full price. We're going to see real quickly what the rate hike yesterday is going to do to home prices. But right now we're in a high unaffordability rate because incomes have not kept up with home prices. And so it's very difficult. The mortgage payment has increased almost 2/3 from just a year ago. It's unprecedented in my career. Interest rates have doubled in the last 6 months, and I've never seen a run up this fast. But back to the 2-1 buy down, Chelsea, sorry, I digress. But you temporarily discount the interest rate for the first 2 years. So let's say the interest rate is 6%. The first year rate would be 4%, the second year 5%, and the third year 6%. It is a 6% no, but we negotiate the cost of the temporary buy down from the seller. It takes $400 off the payment for the first year, about $200 off the second year, and then the third year it remains so. But for 24 months, it helps millennials, I think, step up into higher payments. There's a lot of people who qualify at the higher rates, but they just don't want to pay it, right? It's an emotional thing for them. So this kind of, I think, helps them over the hump I don't know if there's other mortgage companies offering the 2-1 buy down. I know Fairway does. We're nationwide. I know we have some folks on here, I think, from Montana, Colorado, and Idaho. Is that right?
That is accurate. Yes.
Okay, great. Hello, everyone. So we're nationwide. I would think other mortgage companies would be offering that by now, but I like it better than an ARM because it is a fixed rate. With an ARM, you know, the rates start in the 4s, and usually there's a lifetime cap of 5. So you're exposing your buyer to 9% interest rates. But with the 2-1 buy down, it's fixed, and a lot can happen in 24 months. Are you going to make more money? Is there a major installment loan falling off that will justify in the mind of that buyer to pay higher prices? And we don't know what's going to happen with the rates. We all don't know what's going to happen before us. So if rates come down, then you have a chance to refinance. How it works on the 2-1 buy down, just so you know, is the funds are held in escrow, and every month, so if the first year is 4%, funds are withdrawn from the escrow account to amount to the 6% note rate for the first 2 years. So they can refinance anytime, and those escrow funds will go towards their payoff.
Got it. Thank you for that. We've got a couple of questions in the chat that I want to make sure that we address. Jimmy, Bowtie Jimmy, as I fondly call him, our managing director out of Grand Junction. Do you have a national percentage people that took forbearance that are now in trouble?
I don't have a figure, but there was a lot of people.
Mm-hmm.
I talked to a lot of people in the last year who didn't need forbearance, but took it anyway.
Mm-hmm.
That was surprising to me, really. But I think as general, it seems like humans don't want to pay. If they can get out of paying, they will. So, you know, I just saw a figure for the Kansas City, Missouri area agents here that foreclosures or filings in Kansas City, Missouri, metropolitan area up 967%. And I'm thinking, wow. But the good news is they've got equity unless something happens dramatically to our home prices. But I don't know. We'll see what happens.
Yeah, it's been a long time since we've seen an increase in foreclosures like that. So it'll be interesting to see, you know, how the market adapts to it and how, as real estate agents, we can help those folks that are needing out. Another question we have in the chat is, what are some suggested messaging to clients that might be facing higher payments due to the end of mortgage forbearance?
Well, you know, one of the things about the interest rates being in the 2s and the 3s is that pretty much anyone could buy a home. People at McDonald's could buy a home, and we sold it to them. And then with the taxes racing up on them, you got to understand, and that's why it's so important to stay in touch with your people, because people in crisis generally are immobilized. So a lot of times they don't do anything. They don't call you and say, hey, this mortgage payment's gone too high. We can't do this. We need to sell. They just start going into foreclosure. And we saw it in 2008. And then at that time I thought, well, why didn't these people call their realtor and sell before they lost everything? Because that's how people are. And so that's why it's important to check in with your people, because acknowledge the taxes have gone up on their home, and are they still able to afford? Because we are still, like I said, 40% of homes right now are selling at full price. Yes, we're seeing more days on market, and price reductions. But as a general rule, especially considering we don't know what's going to happen, if you have anybody on the fence to list their home, I recommend now.
Nice. And then one of the final questions in here is, what is the highest you think rates will go in your crystal ball?
You know, I don't know. You know, I'm not a professional economics person. I'm just an armchair economist sometimes. I don't know. To me, it seems like the feds have been dramatic here, very aggressive, and it's disrupted some things. For instance, I'm also a first-time homebuyer specialist, and in our market here, and in many other markets, I hope there's down payment assistance and such available. But those loans are priced off the bond market. And for instance, I mean, there's down payment assistance in Missouri, but there's not in Kansas because the rates have been so unstable that they can't price the down payment assistance loan. And that hurts. So right now, and especially first-time home buyers, that's a great market to talk to. They're uninformed. They think you have to put 20% down. It's important to get the word out about, no, there's 3% down mortgages. There's 3.5% down mortgages. There's down payment assistance available. A lot of people don't know this. A lot of people think they have to be on the job 2 years. Generally speaking, I think where they get that is that you have to have 2 years. We take 2 years employment information on the mortgage loan application. You do have to have 2 years employment on an FHA loan, but you do not on a conventional loan. You do not have to. You could be a displaced homemaker who just got back into the market and been on the job 6 months and could qualify for a conventional mortgage. So a lot of people don't know that, but I think the first-time homebuyer market is about 30% of our buyers, and I think they're underserved. And I'm available, Chelsea, if we want to do some first-time homebuyer seminars at the office or something.
I love that. Maybe we can put together even a Zoom event so that we can touch all of our marketplaces with the helpful information. One key thing that I wanted to make sure you shared, because it was something I learned from you in a conversation we had, that a first-time home buyer is kind of a misleading title because you don't truly have to be a first-time home buyer, right? You want to expand on that for a minute?
So a lot of people think that you can't ever have owned a home, but the HUD definition actually is not have owned owner-occupied home in the last 3 years. There's a lot of people who inherit properties that they rent out from their deceased parents and have not, as long as they haven't lived in that home in the last 3 years, they're a first-time home buyer. I'm not sure about other markets, but in Kansas City, Missouri, in our first-time home buyer classes, a veteran is always a first-time home buyer, by the way. So a veteran could own a home now and actually buy another owner-occupied home with secondary eligibility that a lot of veterans don't know they have. You can own 2 homes under VA and get down payment assistance or get lower rates. A lot of agents think that down payment assistance for first-time home buyers is FHA, but it's not. It's conventional, it's FHA, it's VA, and it's USDA. And there's more than down payment assistance. Most agents are familiar with the down payment assistance because we use that program more. But there's also lower rates. Right now on the FHA non-cash assistance loan, the rate's 5 1/8. So if somebody has their own money or a gift from mom and dad or whatever, then they could take advantage of that lower rate. I expect that to go up probably next week. But right now, 5 1/8 is a deal, right?
Yeah, heck of a deal. We also had a question come in. Should we talk to our buyers about buying down the rate?
Well, maybe. If they're going to be in the home for a long time, that might be worth it. It's kind of expensive to buy down the rate. You know, one origination fee, which is 1% of the loan amount, usually buys it down only 1/8 and 1/4, which does almost nothing to the payment. And a lot of people don't know, but lenders are restricted from how much they charge. So it doesn't matter if somebody had a lot of money that they won in the lottery or whatever and had a lot of money and said, I want to throw $10,000 at buying down the rate. You can't do it. because lenders are restricted at it. So you don't get very far with buying down the rate, and it's expensive. And then if rates drop, then you just threw that money out the window. That's why I like the 2-1 buy down, to negotiate that from the seller, because it's their money. And then if rates drop, you're free to refinance. You didn't have an investment in buying down the rate. But it's hard to buy down the rate very much and make an impact.
Awesome. Thank you for that information, Leslie. I'm going to go ahead and wrap it up for today, but a couple of takeaways I know I came away with is, A, make sure that you are in constant communication with your lender. Leslie Lowry is our preferred, so definitely reach out to her as she knows all the programs that can be available. I also thought it was really interesting that first-time home buyer can kind of be a misleading title. It's just, you know, not owning a home in 3 years. So that was interesting. So many opportunities for vets and the increase in foreclosures. I mean, you were just a whirlwind of knowledge. We certainly appreciate you sharing your time with us. We will be lucky enough to have Leslie in our office next Tuesday. So we're happy to have her there. And I just wanted to make sure that you share your contact information, Leslie, for all those at home that are watching. I feel like I'm on NBC. For all those at home that are watching, yeah, Leslie, if you want to take a moment to share your contact information for the good of the group, that'd be great.
Verbally, I'm not sure I know how to do that. Put that in the chat.
Yeah, we'll put it in the chat, but verbally is fine too. I'll put it in the chat for you.
Well, you can always reach me at 816-215-5600. You don't have to be in this market if you have questions. I'm kind of a walking world of knowledge. You just have to tap me and ask. 816-215-5600.
What's your email address?
And it's Leslie, L-A-S-L-I-E .Lowry, L-O-W-R-Y at Fairway, MC for Mortgage Company.com.
Okay, for all those that are tuning in, it is in the chat. Leslie, thank you so much for joining us today. Yes, happy Red Friday, and go Chiefs.
Go Chiefs.